us today. My name is Jolene Olson, and I am a partner and administrative vice president for the Factor Service. We are delighted to bring you this series, A Market Wizard's Dialogue. In this two-part series, Jack Schwager and Peter Brandt will interview each other and discuss the various ventures that they're engaged in right now. Welcome, Peter Brandt and Jack Schwager.
Thank you, Jolene. This is Peter. Yeah, Jack, you're on?
Yep, I'm here.
Okay. Well, hey, this is great, Jack. What a wonderful opportunity to be able to have a couple of these webinars to be able to chat back and forth. We've known each other for a while. I was thinking this morning you and I have had dinner in Miami and in South Carolina. We've had lunch together in LA and Las Vegas, and just a couple of weeks ago, breakfast in Denver, and I'm sure I'm not even remembering all of our times. And it's just been a pleasure to be able to spend time with you over the years, Jack.
Well, likewise, you're a friend, Peter.
Yeah, well, I consider you one too, as well. Here's what I'd like to do today for those of you who are in our audience is really introduce Jack's newest venture, which is just a fabulous book, and it's here in front of me that I printed out over almost 2 reams of paper, and it's a complete guide to the futures market. And I'm a futures trader, so whenever somebody introduces a book, especially by Wiley, which is my publisher, called a complete guide to the futures market, it's something that makes me sit up and listen and be very, very interested. I've got all of Jack's books over the years, which included a 1982 book by the same title, and here we are, 24 years later, 34 years later, with an update of that book. And it is just, I think, going to be the standard bearer relative to people being interested in the futures market. And, I'm just going to go through the chapter titles here, Jack, and then I'm going to start asking you some specific questions. But this is a big book. This is not a small book. This is not a short read for everybody. And I think the book comes out in January is when it comes out, Jack?
Yeah, but January 4th is the latest date I've got from them.
Yeah, well, that's great. But I mean, we've got, for beginners only, just a review of what futures markets all are about. The great fundamental versus technical analysis debate, which I'm going to ask you about, Jack. Chart patterns and technical indicators, types of charts, linking contracts for long-term chart analysis, trends, moving averages, ranges, support and resistance, chart patterns. Another chapter I'll talk to you about, Jack, is chart analysis still valid? Technical indicators, mid-entry and pyramiding, choosing stop-loss points, setting objectives. The most important rule in chart analysis, and I'll come back to that one, Jack, technical trading systems, structure and design, selecting the best price series, testing and optimizing trading systems, how to evaluate past performance, another one I'll ask you about, Jack. 14 popular fallacies, or what not to do wrong. It goes into extensively into fundamental analysis and seasonality, almost 100 pages on that. Futures, spreads, and options, again, a big section. Practical trading guidelines, how to develop a trading approach, 75 trading rules, 50 market wizard lessons. And then, Jack, you go into 86 pages of regression analysis and different forms of regression analysis. That's not a section of the book I spent much time in, Jack, because I'm going to tell you that deep water is way over my head. But the point being is this is a complete guide to futures trading. Is something I think the industry definitely needs. Something I highly recommend to members of the Factor Service. This is heavy reading and must reading. And chapter 1 I love is for the beginners. And question I'd like to start out with here, Jack, is I'm a futures trader. A lot of the people, the market wizards you've talked to and interviewed over the years, I think there's been over 70 that you've interviewed. An awful lot of them trade futures, and there's got to be reasons they trade futures. You trade futures. For those out there that are stock traders and have only considered futures, why trade futures, Jack? What are the benefits of the futures market?
Well, a number of them, as you well know, Peter. But what I'd say the biggest one is futures markets pretty much allow you to trade the world. So you could trade, you can trade all sorts of metals, you can trade all grains, you can trade interest rates, you can trade futures, currencies, you can trade stock indexes. You could basically trade any market in the world, and so that's one great advantage. The liquidity of the markets is a big advantage. They're the most liquid markets among the most currencies are of course the interbank market is extremely liquid, but that currencies are also in part of futures. So there's liquidity aspect. There's the relative low cost of trading futures. If you trade stocks, if you're trading active stocks, then you do have narrow bid ask, but a lot of stocks there, may not be as easy to move into, especially getting the small cap stocks. But it's essentially a market that is easy to trade, allows you to trade anything, and is relatively low cost. It also doesn't require a large capital outlay, although mentally you need to think of the amount of money you're trading as larger than the margin, obviously, or else you'll be in big trouble. But it does allow you to not have to put up a large amount of money to control a large amount of assets. So those are all advantages, and those are ones I would list.
Yeah, let me just ask you a quick question. I wasn't going to, but you mentioned it. You use the word margin, and people think, why is the word margin wrong when people are thinking about trading futures market? Why is that not the proper term?
Well, technically speaking, it's a good faith deposit, and roughly speaking, I don't know what is I haven't looked at it recently or recent years even, but I guess 5% or a little less is what you typically have to put up of the contract value. And of course, if the market goes against you, it's just a good faith deposit. You don't have to put up more. The thing though is that you don't have to tie up a lot of cash, but you do need to think in terms of, if you're putting up 5%, well, you don't have to think of it as 100%, but you really should think of it as that your account should really be your mental account. I would say should probably be 10 times that number.
Yeah, well, that's great. Thanks for that clarification. I that's one that people don't quite understand, I think, a lot, and that's good, Jack. Chapter 2, you have it's the great fundamental versus technical analysis debate. Talk to that point, to that chapter, would you, Jack?
Yeah. Well, this is a kind of a theme. Well, first of all, it's a theme personally. I started out as a purely fundamental analyst, didn't pay any attention to technicals or charts, or thought it was just, my background is as an economist and, educationally and so forth, so maybe predisposed to be skeptical of things like charts and stuff. But so I started out from that one end of the spectrum and ultimately ended up at a spectrum where I was just literally 100% technical. That's not to say that is what I'm recommending for everybody. It's just to say that was my own personal journey, but I've had experience in both areas, and that's why I could write a book which also talks a lot about fundamentals. I did a lot of work in that area. The debate part of it is that you have people who are, like I started out, who believe fundamentals is the way to look at markets and have disdain for technicals, and then you have plenty of people on the other direction. And what I have found basically through my Market Wizard books, where I've interviewed lots of people, which range from pure fundamentalists to pure chart people, and finding people in both camps that were extremely successful. So there's this debate, and I think it's one of those things where both sides are right and both sides are wrong. there is no absolute right answer. It's not like fundamentals is right and technical is wrong or vice versa. They are both right for the right person, and they're wrong for the wrong person. And I think each person has to discover which approach resonates or works for them. And for some people, actually, it's a combination of two. So I can think of somebody like great trader like Bruce Kovner, who was a phenomenal fundamental thinker. He would basically, this is a guy who could discuss with you the economic situation of every developed country and understood all the major trends and currencies and interest rates across the globe, how they interacted, the history of them going all the way back, and yet when it came down to trading, would also pay attention to charts for entry and exit. So he's somebody who's kind of embodies like a hybrid approach. So the debate basically is that, and the conclusion I think is that neither one is absolutely right or wrong. It's really a matter you've got to discover which one works for you.
Yeah, that's a great point. And Bruce Kovner is probably, I'd have to say he's my hero. I mean, he is. I admire him so much, and he's probably among a handful of the best traders that have traded these markets. You have a chapter in here, Jack, that I just sat and laughed and roared about. It's your chapter 3, and for those of you who order it and receive it, it's one that you're going to enjoy. And the title is Charts, Forecasting Tool or Folklore. And you have a little dialogue going on here, Jack. It's set up as a dialogue between Professor Coyne and Ms. Trend and the moderator. And I
Professor Philip Coyne.
Yeah, Philip Coyne. I'll tell you, I just about laughed till my stomach hurt on that one, Jack. So give just kind of a peek preview of what that chapter is about.
Yeah, so I'm glad you liked that because I had some fun with that chapter. The readers to really appreciate that have to be old enough to be familiar with Ruckheiser's Wall Street Week because it's a bit of a parody of that show. And those of you who remember that show, Ruckheiser was a great punster, and so I kind of ran, I guess, rampant in that chapter with puns. But anyway, I just had fun with this idea whether with a debate. It was a obviously fictitious debate between a professor who's a proponent of the efficient market hypothesis and a young lady who's a chartist, and that's the premise of that chapter. But they get across, although it's just, part of it was just to have fun with the humor of it, but to get across the very real ideas that the technicals have a lot to do. That the efficient market hypothesis people miss a lot of things about why technicals work.
Yeah, no, I would agree with that. I used to watch that show, and that was a great watch each week. You then at this point in the book, in chapter 4 and 5, you get into charts. I just appreciate, by the way, Jack, the amount of space that you devote to the charting, and of course, most people that are listening in know that charting has been my livelihood, and I appreciate the amount of attention you gave to it and the amount of attention you gave to a whole wide variety of things in dealing with it. You deal with the types of charts, bar charts, line charts, candlestick charts, close-only charts, point and figure charts. And then you get into chapter 5, and I want to ask you about that, Jack. It's linking contracts for long-term chart analysis, nearest versus continuation futures. And I get a lot of questions from factor people on this subject, Jack, because I tend to do most of my analysis with certain kinds of continuation charts. And talk a little bit about this whole concept, because I think it's a little confusing for stock people when we start getting into how we do create these continuation charts. Talk a little about that, Jack, and a little bit about how you lean on the subject.
Sure. So, well, if you're trading stocks, you basically have a long history and is, it's one continuous series and pretty straightforward. And if there's splits, the thing gets adjusted backwards and stuff. So you're always dealing with one clean series that shows that if you go back and you look 10 years before and you look at a price and it's $10 and now it's 50, you know that if you bought it 10 years ago at 10 and it would have gone up $40, it's pretty straightforward. Trouble with futures is most of them have very limited lifespans. They have a few, the only real exceptions are Eurodollars, which trade for multi-years of liquidity, but by and large, futures, in fact, many futures are only liquid for less than 3 months. If you go back beyond that, you start getting a lot of spaces and dots and lack of liquidity type of looking in the charts. You certainly can't get multi-year charts out of them that are meaningful, except for a few markets. So you have to solve this problem: is how do you look at the long term? And I know, Peter, you and I are similar in many, many ways in the way we look at markets and charts and technical analysis. And one of the similarities I know we have is we both believe in, it's kind of ridiculous to just like look at a three-month or let alone intraday chart and not know what the big picture is. And so ideally, you don't really want to start with a 10 or 20-year chart picture, know what the big picture of the market is, and then go down to a 3-year or 1 year. And if you maybe then go down to a 1 hour, but bottom line, you really need to see the big picture, else you don't know where you are. So it's like if you were blindfolded and dropped in the middle of New York City and we're asked to describe what the United States looks like. Well, if all you've seen is just New York City, you'd come up with a very, very distorted picture of what the United States looks like. And so you really have to see the big picture to start. And you can't do that with futures contracts by themselves. So you must link the contracts. The question then becomes, how do you link it? Well, the initial way it was done, and the way it's still done, and it still has a purpose, is you take one contract, it expires, you take the next contract, link it, and so on. Well, that sounds fine, and that sounds good, and that will give you an accurate description of the price level. And I really want to emphasize the word level here, the price level in the past. So it will tell you where a market was. So if you look at a market and it was $2 10 years ago, and now it's $4. You know the level was $2, but what changes in futures is, unlike a stock, where if it goes from $2 to $4, or maybe let's say take a large number, say $20 to $50, that's a $30. It's $30 higher. Well, in futures, if you're looking at a long ago price, you can say the level was $20 or $30 lower, but what you cannot say, and this is critical to understand, is that the market has risen $30. It's entirely possible the market could have gone down in that period if you would have actually lost money being long. Now, how is that possible? The reason it's possible is because there are gaps at the rollovers between contracts. And when you link together contracts without adjusting for those gaps, then you don't have an accurate, you don't even have, in many cases, a remotely accurate or even representative picture of what's happening to your equity. And so, if you're concerned about what your account looks like, what your account equity looks like, whether you would have made money or lost money on a trade, then it is absolutely critical to link contracts in a way that adjusts for the gaps at rollovers. So if you, let's say if you typically roll over, if you have a sort of a rule that you roll over the first day when the new contract has more volume than the next contract, or let's say 20 days before the contract expiration, or any rule, whatever that is, if at that point you link together contracts and you check what is the gap between the contracts and adjust the price series for that gap, and then keep a cumulative running total as you go through time. Of course, you do this. This is done either by program software, or you'd have a program. You wouldn't actually have to be doing this manually. But bottom line, the series you're looking at should be one that adjusts for the gaps at rollovers. And then that chart will represent the price moves as opposed to the price levels accurately. And in futures, you can't represent both. You can only represent the price levels accurately, or you can represent the price movement accurately. It's impossible to represent both, because once you represent it one way, you automatically are not representing it the other. So if you want to know levels, you look at a nearest futures chart. If you want to know price swings, price moves, magnitude of moves, you must look at a continuous futures chart. Anybody who says otherwise is basically ignorant or wrong or both. So those are my strong feelings on that subject.
Well, thanks, Jack. I'm going to have to consider myself a deplorable on that one, I guess.
No, not really. I'm sure. No, let me because let me just specify here. So, and then you'll tell me if you disagree, because I don't think you would. Now, if you're looking at chart analysis, if you're looking at charts, historically, you probably want to look at both. You probably want to look at nearest futures, because that gives you the historical levels. So if you're looking at support and resistance and stuff like that, you want to look at a nearest future chart. But you also want to look at you must look at a continuous future chart, because that's the only chart that's giving you swings accurately. So if you're looking, let's say, for something like a measured move, swing, and equal swing, well, you need to adjust for the gaps and rollovers. For trading systems, I don't think there's room for nearest futures. For trading systems, if you are programming a system or testing a system or trading a system, it must be continuous futures, because otherwise the results of the system will not match your account, and that's obviously not a good thing. Now, if you could disagree with that, Peter, I'd actually be interested. How?
Well, my disagreement with it, and I agree with you that there's a room for both. There's a place for both. And one of these days I'm going to have to maybe spend a couple of pages in a factor update to discuss this and show what both types of charts look like. But my main complaint with back adjusting is, because that's what you do, is you end up having to back adjust prices, is that you end up with a chart that shows 4 or 5 years ago prices that never existed.
Oh, absolutely.
Yeah, but I'm for both, and I think on this one where I come down, Jack, is there's an argument to be made for both, and the question a trader needs to ask himself is, which type of chart works best for me? In all things, I think it comes down to which type of chart works best for me. But I think I'll send you the write-up that I eventually do on it for your review before I put it out and get your feedback, Jack, and we can.
Yeah. So no, I agree with you, Peter. And not only you get prices, by definition, you have to get prices that didn't exist, because if you want to represent the accurate price swings and there are gaps and rollovers, by definition, the prices are not going to match. Not only that, you could actually go back far enough. In many markets, you could actually end up with negative prices. Obviously, so for stuff like support levels, that's not going to make any sense. So that's why I say you need both. You have to go nearest futures as well. But for anything that you want to reflect price swings, particularly, like I say, trading systems where you want the movements that the system believes is occurring to match your account equity, then you must use a continuous series.
Yep. Well, good. Thanks, Jack, for your input on that.
Oh, I'm sorry. One other qualification here, fine point, but it's important. If you use continuous futures for percentages, you can't use it. You can only use the price change. For the base, you still would need to use nearest futures, because otherwise it won't work for percentages. So, because again, the price levels are not accurate, so you have to use nearest futures for the base to measure how much of a price move occurred in a percent term, if you're using percentages.
Thanks, Jack. Good clarification. Hey, Chapter 15, people I think are going to find most interesting, and this is something that you often hear people say, well, charting doesn't work, and there's just too many cases where charting doesn't work. I don't believe in charting because it doesn't work. You have Chapter 15 called the most important rule in chart analysis, and Jack, this is one you and I both agree on. Would you speak to this?
Sure. And when I sent you this book, I knew, Peter, that you'd really that chapter would really resonate with you, because I know the way you approach markets. And that's something. This is something I noticed and discovered very early in my career once I started looking at technical analysis charts, and that is that take any pattern you want, breakouts, whatever. You've got lots of failures, and people will say, "Oh well, charts don't work." Well, if you're going to believe that if your approach to chart analysis is you've got a textbook definition of these patterns, and whenever they occur, let's take a simple one like a breakout. You got a trading range, you get a breakout. Okay, so every time you get a breakout, that means the market is going to go in that direction, and when you do that, and then a lot of times you buy it, and then the market goes back down, and you lose. It happens a lot of times. You say, hey, this is a bunch of garbage. This doesn't work. Well, if that's the approach you use, it's not going to work. The point is, and this is the key point of that chapter, and I would say about everything I wrote about chart analysis, it's the most important point to me, and that is, it's not so much the patterns that are important, it's what the market does after the pattern. So if you have a breakout and the market then fails and goes back into the range, that as a failed signal can be a much more reliable signal than the actual breakout itself was. So that chapter goes into many kinds of examples of failed signals. And my contention is when classical chart analysis doesn't work, those are actually really good signals, better than the original signals. And so you need to appreciate and understand that and not take it as a cookbook type of approach. You have to pay attention. There may be an edge to the classical chart pattern working, but if it doesn't work, you've got to give a lot of weight to that. And failed patterns are among the most important tools, I think, in any chart trader's book, and I know that's something that you do a lot of.
Yeah, oh, absolutely, Jack. I define failed patterns as a pattern in itself, as a singular pattern. And so you look at a symmetrical triangle that fails, it produces what Schwager called an end around. Schwager and Edwards and McGee both identified the failed head and shoulders. And so, yeah, absolutely, failed patterns are very, very significant. And I've always said that actually chart patterns in and of themselves do not provide a trading edge. It's risk management, and it's some of the techniques of trading those patterns that really give the edge. You in the book, in part 4, Jack, spend 80 pages. I love this, and I haven't read it yet, but I will at some point. And you talk about mechanical trading systems, and you go deep into it, and it deals with the issue of will one be a systematic trader or will one be a discretionary trader? I am a discretionary trader. I add judgment to the equation on just about every trade. You're talking here in the book about people who move away from discretionary trading toward systematic trading. The question I have, Jack, is give us the narrative for why one would become a systematic trader. What is there about systematic trading that one should consider as being an appealing thing for them to do?
Okay, great question. And interesting, just for context and background, I went from being fundamental to chart oriented to going to systematic, and then going back and then eventually just being discretionary chartist again. But it all deals with what you're comfortable with. Now, the reason I originally went from discretionary to systematic is the one big advantage of systematic, besides you being able to test things and so forth, which is a big advantage, but in actual application is it takes the emotion out of trading. Because if you're going to be a true systematic trader, if you ever find anything that gives you a reason why you want to interfere with the system or do something different, then if you're a proper and good systematic trader, you should then change the rules to incorporate that thing that you want is making you want to go different. So over time, the system should reflect exactly the way you want to trade, because if it ever is in conflict, you should then modify the system so to get rid of that conflict. So by definition, you should get at a point where the system reflects the way you want to trade. Now, the great part of that is it takes the emotion out of it because it's automatic, it's computerized, you fed it the rules you want it to do and so forth. And that's one big advantage that's the big advantage of systematic trading. And for many people, for most people, maybe emotions are the big pitfall, because human emotions are just not very helpful for trading. And I mean, the good traders can really be stone cold and don't let their emotions get in the way. And you know, you can't tell whether you really almost can't tell whether they're having a great day or a bad day, because they're just doing it as a process, and it's like a job. They're focused, and they're not getting all emotional about it. Now, I don't have that quality, which is one of the reasons why I went more, you know, for a while went the systematic route. But that's the advantage. It gets rid of the emotion. The negative of that, of course, is you don't have control if you're following the system in that sense, and you may have to, and that means that for the system to work, you have to allow a good amount of risk on many trades, because if you don't, the system will be getting knocked out of good positions all the time. So that requires a lot of your ability to take that, those interim losses without directly controlling it. And so ultimately for myself, I felt more comfortable just having direct control and being able to just immediately get out of a position if I didn't feel right about it or whatever, and took care of the emotional part about it. The way I solved that, we talked about Bruce Kovner actually, and what I call Bruce Kovner's dictum. So what I apply to my trading is his rule that know where you're getting out before you get in. So to me that means, and I think, Peter, you do exactly the same thing. If I'm going to enter an order, that order doesn't go in alone. That order goes in with a stop loss attached. So the emotion is taken out of it, because I've already decided what my worst loss is going to be other than slippage, and I don't have to think about it. And so the order goes in, the stop's there. If the market's going to go dead against me, well, it's going to go against me. I've already taken care of that. I've limited the amount of damage that can be done by the stops. I've taken the emotion out of it. So that's that. But yeah, if you don't do that, then certainly systematic trading is advantageous in that it does get rid of the emotion.
Yeah, thanks, Jack. That's good insight. Say, there's a book you wrote that a lot of people don't really identify as really a book. They think of you as the Market Wizard series, right? And there's a book you wrote a couple years ago called Market Sense and Nonsense, and I've tried to promote everywhere I can. And you're not noted for it, but I think it's actually really one of the most brilliant things you've ever written. And you get into how the markets really work and how they don't, and you get into a lot of metrics, how to evaluate performance. And you have a chapter in your book on how to evaluate past performance. And in that chapter, you talk about really is good ways to measure and what are bad ways to measure, what metrics are the best metrics, what metrics do people pay attention to that actually don't really count for much. Explain that, talk to that a little bit.
Sure. Well, actually I've adapted that chapter for this complete guide as well. So the performance analysis chapter in this book was adapted from that Market Sense and Nonsense. Okay, so as far as measuring performance, I guess the biggest message I would have is that the mistake most people think is they look at return, particularly when you're evaluating. Forget about just being a trader yourself, but if you're looking to invest in money managers or whatever, and if you're looking at performance, people tend to have bias to look at returns. I got But people say to me sometimes, well, I've been making 30% of return. Are you interested in knowing about more? And to me, it's a stupid comment, because how do I know what the risk is? You may be making 30% return, but you might have 60% drawdowns, and it's just a matter of time before you blow out completely. So my main point about performance measurement is that return alone is a meaningless measure. You have to normalize it by a risk measure. And the analogy I use is it makes as much sense as now that the pound is go down, the analogy isn't as good, but my analogy was that if you go online, you're looking for hotel rooms in London, and one room is 250 and the other room is 200, and they're both on a different site. It's 200, and they're both identical rooms, exactly the same. Which one's better? And of course, it sounds like a trick question, because it is in a way, because of course you take the cheaper one, it seems. But I say, well, what if? And let's think in terms of the pound being 140, 150 instead of what it is now. But let's say, what if one side is in terms of the pound and one side is in terms of the dollar? So if the 200 is in pounds, it's no longer the cheapest one. And my point there is, it doesn't make sense to just look at price unless you normalize it in terms, what is the denominator? Is it pounds or dollars? And in terms of trading, the denominator is risk, and whether you're using the use volatility or use some loss measure or whatever, you need to normalize it, because otherwise you get real distortions. For example, I tell people, you want to double I'll tell you how to double your returns. It's very easy. Just put on 2 times your position every time. Of course, you'll lose twice as much every time you lose. So that doesn't mean you become twice as good of a trader. It just means you're risking twice as much money. And so you need to control and normalize for that. Now, as far as specific measures, I'm not a big fan of the Sharpe ratio for the reason that the measure it uses to normalize. I mean, it's okay. It's okay. It's not just not the best measure, but it uses volatility to demonstrate risk. And volatility, in many cases, will be a reasonable proxy. Where it goes wrong, though, is that traders aren't really risk perception, or what we feel is risk, is not really volatility. It's loss. I mean, I've never met any trader who had a problem with upside volatility. They're making too much money. That's never a problem. The problem is losing money. Now, the Sharpe ratio doesn't distinguish between upside and downside volatility, which is what the problem is. So you can have traders who are very good at controlling their risk and let their profits run, the cliche but true. And a trader like that will get some really big gains, and so you'll get upside volatility, and the Sharpe ratio will say that's bad, but it really isn't. So you get that type of distortion. So that's why that's the main reason why I'm not a big fan of the Sharpe ratio. So I think it's better to normalize with something that really relates to what people identify with risk, which is namely loss. And there are a number of ways of doing it. The Sortino ratio, which uses downside volatility, is one way. My own favorite measure is something I call a gain to pain ratio, which simply sums up all the ideally using daily data, because it's most meaningful with daily data, but you sum all the daily returns, positive and negative, and you divide it by the sum of all the absolute value of the sum of all the losing days. And that gives you a very, very good measure of the return you're making relative to the risk you're taking to make that return. You could do it with monthly data. It's just daily data gives you more information. And from the interpretation is different from monthly than daily, because obviously when you get down to daily, you could have months, positive months, but you still have daily losses. So the daily number is always going to be much lower than the monthly number. You have to be cognizant of that. But I go into all of that.
Well, thanks, Jack, for that explanation. And members of the Factor service know that's something I talk a lot about. I've presented the actual formulas for gain to pain and Kelmar, which I follow. Jack knows that I follow something called profit factor, and we've talked about that. But I think it's important. People trade the markets, and they know what their rate of return is, but they don't know the internals. That's like taking temperature of a patient in the hospital, but not taking a look at his blood or doing x-rays, and so it's important. You then in the book go quite a bit, and I'm not going to have any questions for you, but I'm just going to mention it, Jack, a big section on fundamental analysis, different types of fundamental analysis. You then venture into spreads and options on futures. Great section for people becoming acquainted with the futures market to read. And then in part 7 of the book, in chapter 36, you talked about a planned approach to trading, and that's one of the 4 pillars of the factor service, and it deals with the process. It deals with approaching trading as a business, as a serious business. Speak to this planned approach that you kind of get into in chapter 36, Jack.
Well, for one thing, obviously you have to define what your approach is. You just can't be like the shoot from the hip approach and hope you make money. One of the big things I advise, I believe, is in that chapter, and it does take work and discipline to do, but it is very helpful, particularly for early on traders and as you're learning and developing, and that is keeping a log of not necessarily every trade. I mean, you can certainly keep the results of every trade, but I'm talking about actually, in the ideal sense, to give you people an image, you would actually print out a chart of when you get, let's say you're a chart trader, you print out a chart of where you got into the trade, annotate why you got into the trade, and then follow up with when you got out, why you got out, and most important at the end of that, when the trade's complete, if there's a lesson to be learned, write it down. Now, most of the lessons to be learned will be from losing trades. That's the way it is, and in fact, to become a successful trader, I think you have to be able to capitalize on learning from your losses. So whenever you do something that you see that was wrong, not a trade that you, let me be clear here, not a trade that you lost money. That's not the same thing as being wrong. You could have a trade that lost money that is a perfectly good trade, and you should take every time it comes up, because it's like if you're getting paid $2 every time a fair coin is tossed heads, and lose $1 when it comes out tails, and you keep on betting heads. When you lose on heads, that's not a bad bet. That's still a good bet. Same with trading. If you've got an approach that works, if you lose money or not, as long as you follow that approach, it's not a bad trade. So that's not relevant. What's relevant is when you did something that was wrong, or you overlooked something, and you say, oh, okay, this trade didn't work because when this happens, I gotta remember, that when this happens, I've got to change, I got to do this, or I should have gotten out, I saw this happen, and I didn't get out, never do this again. You've got to basically write up what the mistake was. And sometimes, sometimes though, you may get a pattern or something that works. It's not, let's say, a common pattern, but you want to keep it as a reminder, and you say, well, here's a good pattern, here's an example where it worked, keep this in mind, look for that. Whatever, it doesn't always have to be write up a lesson on the negative. It can also be on positive, but in practice, the most of the lessons that you'll learn will be from the losing trades. And if you keep those, and you keep them in sort of a log or a diary, and then you periodically go back and review them, it will do one thing. It should do one thing for sure, which is worth its weight in gold, and that is it should keep you from repeating the same mistakes as often as you would. Maybe, hopefully, not repeating them at all, but certainly will cut down repeating the same mistakes. So just reading it, when you did that, if you read that a couple of times, you make the same mistake. The next time, for example, I'll just take something myself. I basically, like you, Peter, make decisions at the end of the day, right? And during the day, I look at the market sometimes, and I'll make trades. And I kept on saying, every time I make a trade during the day, I lose money. It's like, I said, I'm just going to stop. I just can't, anytime I'm tempted to do a trade during the day, I'm not going to trade. It's just not going to do it. So it's that type of thing. You have to be cognizant of what your mistakes are, so you don't repeat them.
Yeah, hey, and that brings me to my next question, Jack, and it's your chapter 37, which is 75 trading rules. We're not going to go through all 75, but name one or two or three of those 75 that most resonate with you.
Gee, I don't think, I'll tell you honestly, Peter, I put that, those are like rules I do about charts and, I don't even remember offhand which ones what I put in, honestly. I can actually pull let me pull out my old version here. See if that pops up, just to give people know what we're talking about here. I don't know which were my favorites, basically. I mean, maybe you want to just pick out a couple that resonate with you offhand. So.
Yeah, well, there's so many. It's just, it's. I mean, it's just common sense stuff, right? I mean, you talk about.
Some of it yes, and some of it not. Yeah. So some of it yes, some of it not. But there are things I just like noticed about markets, or. I'll give you a couple off the top of my head. I believe they'd probably be in there. So for example. This is not as most important, but just to give people a flavor of what type of thing we're talking about. So, for example, probably one of them would be if you're ever if you're in a trade and it works right. If you're looking for a certain type of a move and you get most of it very, very quickly. From my opinion, and again, this is not common sense. It's not necessarily even right. Maybe a lot of people disagree, but I found if that happens, just take it. If you get most of your move very, very quickly, just take it, because even if you get the whole move, there's a good chance that the market will probably correct. You'll be able to put the position back on and get in and ride that trade again at a better price. So that's like an example of it. These are just things like observations I had, over time. Or I think one of them may be if you're going to get in a trade and it goes against you immediately, get out. That type of thing. So these are just things like, from experience, you see these things happen and you just mark them down. And my list may not be somebody else's list. I think it's a good idea for people to have their own list.
No, I think a lot of these lists are, the interesting thing is as I read through these, I realize that every one of them has probably given me a black and blue mark at some point. And
well, that's why they get in there, right? So they give me one too. That's why they get in there. So so don't make that mistake again, type of thing. And
well, that's awesome. Then I'm not going to question you on it, but I'll just mention it. You have a chapter on the 50 Market Wizards lessons. You've done a number of those books. Those are great. And then you end the book in really kind of a way that I mentioned earlier takes me way over my head. It's an appendix, but it's
the
100-page appendix on regression analysis and things like that. And for those of you who are into the math of trading, the statistics of trading, you'll love that section. Again, it took me into waters that are deeper than I wanted to go, but. My recommendation for everybody is order your book. Get it now. Go on Amazon, order it. Let's put Jack's book into a position of the #1 selling financial book and keep it there for as long as we can. It's not an inexpensive book. I think it's over $100. I've ordered it. Jolene's ordered it. Even though I have a copy that's printed out of my printer, I'd like the real copy. And then you'll have to autograph it when we have lunch or dinner together, Jack. But
absolutely,
I highly recommend it to people. It's great. I want to turn a corner here, and it may take us a little past the 1 hour mark, and so I'll apologize to you for it. Jack is also engaged in an endeavor that I am fascinated with, and it's called FundSeeder. Jack, explain a little bit what FundSeeder is, why people should be interested in FundSeeder. What is this FundSeeder thing all about?
Sure. Well, the origin concept, and I should say, the fund company was started with 3 partners, of which I'm one, and the main mover on this, and the person whose idea it was, is a fellow by the name of Emmanuel Bellari, who's the CEO. And he was the one who pitched it to me several years ago and asked me to join him in it. In any case, the basic concept was to create a web-based center where you could connect traders and investors. Although we've done it basically with two separate websites for legal reasons, but from the trader side, the idea is the trader is able to get link their accounts to the site, have their accounts updated daily, be able to generate all sorts of analytics and charts. For example, just to get I think it's great to just be able to get an equity chart, to get a chart of your equity and have that updated every day. That's very helpful. And to run analytics on it, you could even do stuff like test. Well, what if I use a crossover moving average on my equity curve and got out when the moving average turned down and got back in when it moved to turn up, that type of stuff. But in any case, I'm getting off on a tangent. The idea was to give traders the opportunity to link their accounts, to have these accounts verified in real time because the numbers are coming from their broker, and get people globally to participate, and traders across the globe who have talent to put their accounts up and to discover trading talent that otherwise would have no avenue to getting any investment capital. Because you could be a great trader, but if you have not gone to an Ivy League school, and particularly if you have no connections per se, and you don't have a big amount of money to back you anywhere, you don't have the connections, then you could be the greatest trader in the world. Nobody's going to find you, pay attention to you, and you'll never get an interview. You'll never get anywhere. So the idea here was to sort of globalize and democratize this process of traders being able to become managers if they have skill. And so anybody anywhere in the world can go on, put their account, and if the numbers look really good, they have an opportunity to be discovered. And then we and investor partners can use that database to find trading talent and allocate to them. And already first allocation has already occurred, and there'll be, I'm sure, a lot more. And we're just very early on the FundSeeder investment side. So that's only just beginning. But that's the idea. The idea is no matter who you are, if you can trade, if you've got skill, you can demonstrate it by putting your account up there and have the opportunity to manage assets.
Yeah. Now this is a good question. I'm putting a ball up on a tee-ball here for you, Jack. What does it cost somebody to be able to get all of the metrics and material that come out of FundSeeder? How much does it cost them?
Yeah, it costs zero. So sort of using the Google model there, I guess. So the idea is we didn't want to put any impediments into people joining, signing up and linking up. And our goal is to get a larger base of traders, hopefully good traders across the globe as possible. And if you put any cost on it, obviously that would impede that potential. So our way of monetizing this is not through the trader. Well, it is indirectly through the trader, because those traders the ideal model is those traders who are who are good and discovered and end up getting allocations from the investment side. We will have then agreements with those traders to share in fees they earn. But that's only cost. That's only if we're directing money to them, but otherwise there's no cost at all.
Yeah, what you're really talking about, Jack, is really in real time finding the next people that you might put in a Market Wizards book, right?
Well, yeah, I mean that's an offshoot of it, of course. So the thinking is, well, if we've got a site here to discover global trading talent, then kind of a neat book would be to do a book which I've got tentatively titled Undiscovered Market Wizards, and where not now, but maybe a couple of years from now, after the site's been running for a few years and able to identify a number of people globally, pick the best of those people, and I kind of envision myself doing a around the globe trip where I interview those people. So eventually, that is the plan, to have a book come out of this that will feature some of the best traders that were found through this process, and So that's part of the project. But the main part of the project is really to find these traders, and then through our separate company, FundSeeder Investments, connect them with institutional type investors.
Now, this is for futures, forex, and stocks, correct?
Okay, so right now it's futures and currencies essentially, but certainly, but anybody trade equity as far as the allocation process, because our registrations on the FundSeeder investment side are right now just for the futures side. But our plans are certainly to expand that to cover equities, and that will be done once the appropriate legal compliance and registrations, everything is done strictly according to the rules. So that's the only thing that's impeding us from doing anything there right now. But the trader side is separate, and we are certainly seeking and actively encouraging equity traders to link up. And in fact, probably we have more equity traders than futures traders. So all traders should. It's just a matter of time. We can only do things once. We can't do everything at one time. So the investment side, that is now gotten going on the futures and FX side. But our absolute intention is to expand that to certainly include equities.
That's wonderful, and it may not be for everybody. How many traders are you now tracking on FundSeeder?
Well, we've got, I think the most recent signups were around 5,000, and then there's various degrees. I mean, traders. There are people who haven't linked that have signed up, but there's probably several thousand of actually linked accounts or accounts, or I should say also, I should make clear, because we can only link with brokers where we get their cooperation. So, and it's also work to link. Every broker you link to requires programming and software. So we have some major partners, brokerage firms that are linkable, but certainly not everybody. So when there's brokers that are not linked, traders can still put up their numbers. Those numbers will be identified as unverified, because we're not getting the numbers from the broker, we're getting it from the trader. But all the same analytics, everything else would still apply. And we will still look at that database, because we understand that there will be perfectly legitimate traders who will sign up but won't be able to link because their broker isn't linkable yet. So we still look at that database as well. So I don't know what the breakdown right now is between linked through brokers, linked people who have put up their numbers, otherwise the people who have just signed up and haven't yet set up their account. But there are, like I say, about a total of roughly 5,000 signups, I think, at this point, and the numbers are growing continually.
Thanks, Jack.
And they come from all over the world. I think we have over 100 countries represented.
Yeah, I recommend that people check out FundSeeder, see if it's capable, see if it's connected with your brokers. I mean, for me, I would see it as very valuable for two reasons. One is it just it can give you great metrics on your trading. It really, I will tell you, I believe sometimes that trading produces metrics, but metrics can govern trading. I mean, metrics, you can get a designer trading program by understanding your metrics. At least that's been true for me. But also for traders that you want to trade, but you for a living, you want to be a full-time trader, but you do not have enough capital in your account to really be a full-time trader, and you envision that it might be a long time before you generate enough profits to get there. Well, one option obviously is to seek outside money. Think of it this way: if you're managing a certain amount of money, let's say you're managing $3 million, which for me equates to about a 30 contract position, and you're taking 20% of profits. It's the same thing as being able to trade 6 contracts with no downside risk. And so if one's inclined to want to be a money manager, be a trader, and being a trader by managing money, it's a great way to establish a track record. But anyway, Jack, that's about it for today. We've actually come in and landed this plane.
Yeah, you did extremely well. Yeah, you could do network TV with that time accuracy.
Yeah, well, thanks, Jack. I really appreciate it. I ask people to stay tuned.
Peter.
Yeah,
Thanks.
we're gonna do this again, and Jolene, you'll send out a notice, right, to people the next time Jack and I will get together, and it'll be Jack mainly trying to get into my head at that point.
Yeah, we'll
Jolene.
change roles.
All right, well, thank you all for joining us and giving us an hour of your day. We certainly appreciate that. And Jack, have a happy Thanksgiving and
Hey, you too, Peter.
enjoy yourself. And thank you all for participating in this. Thanks, Jolene. I'll let you close it up.
Thank you. Thank you again, everyone, for joining us today, and thank you, Peter and Jack, for allowing us to be a part of this dialogue. Please stay tuned for more information regarding session 2 of this series. Jack will talk to Peter, and he will give us his insights on 40-plus years of trading and also what's on the horizon for him. Thank you again for joining, and I hope you have a fantastic day and weekend.